If you don't understand leverage or you're not utilising it properly, you're probably missing out on the biggest superpower within property investment. Hi, my name's James, and if you're new here, this channel is all about helping property investors build and grow their knowledge about property investment throughout the UK. I'm the co-founder and managing director of a property investment business called Freighter Property Partners, but this channel is all about helping you build and grow your knowledge to become a more informed property investor. Don't forget to hit like and subscribe to the channel if you find this content interesting. As we've already touched upon, today's episode is all about the power of leverage. I'll explain what it is, how it works in real terms, and how to utilise it to best grow your portfolio. So stick around and I'll share my screen in a minute to show you how the numbers really play out. So what is leverage? Leverage is essentially using somebody else's money, usually the banks in the shape of a mortgage, to invest in property. This means that rather than needing £200,000 to buy a property worth 200k, you'll only need 50k, which is a 25% deposit. This means that not only you can leave more cash available for other deals, but it also gives you a better return on investment over time. It really is the superpower within property investment. You can leverage using other people's money in different investments. However, the risk is usually significantly higher than leveraging within property investment. So why is it powerful? Essentially, leveraging or buying with a mortgage gives you the opportunity to get a return on the full value of the property, not just the amount of cash that you've put in. So let's say, for example, you buy a property worth 200k, that property grows by 10% in a year or 2 years, 3 years. That extra £20,000 that the property is now grown by is your money in terms of equity. In the future, you then have the opportunity to refinance that property and release that equity so you continue to scale your property portfolio. Also, just because we're using mortgages doesn't mean we don't also get a rental profit. Yes, we pay a small amount in terms of the mortgage costs, but we make a rental profit and we benefit from the growth of the overall value of the property, not just the cash you put in. So, let's look at the numbers in terms of some examples. So, for example, let's look if you had £100,000 and you were ready to purchase a property. Obviously, the chances are you have a bit more than £100,000 because you'll need to pay for things like stamp duty, legal costs, broker fees, but let's say £100,000 is going into the property. First and foremost, what you could do is you could take that £100,000 and buy a property in cash. If you bought that property in cash and that property grew by 10% over 2 years, that property would then grow to around £110,000. That means your equity in the property would be £110,000, the £100,000 that you put in, plus the 10 grand of growth, which is a 10% return on investment, which is okay. It's nothing to be sniffed at, but you could do better. Your second option is you take that same £100,000 and you buy a property worth £400,000. So 100k is a 25% deposit, which then goes towards the property. You mortgage the rest on an interest-only buy-to-let mortgage, and you benefit from the growth of the overall property. So in that time frame, let's say 2 years again, you see that same 10% growth, and that property that's worth £400,000 has now grown to £440,000. That means from the initial £100,000 you put in, of the capital that you put into the property, that is now worth £140,000. So it's a 40% return on investment. You might look at that and go, wow, stamp duty is quite high now. I don't want to have to purchase properties that are quite that expensive. So what else could I look at? You've then got the option again to, rather than look at a property worth £400,000, you could buy 2 properties worth the 200k mark. That £200,000 is in and around the average price of a property, probably a little bit under that with this type of property, but we're there or thereabouts for that, so I should see some strong growth moving forward. So if we take that example, we buy 2 properties worth £200,000. We put 50k deposits in both, which again is 25% of the purchase price of the property. You mortgage the rest, and in that time frame of that 2 years with a 10% growth, your property will grow, or each property will grow from £200,000 to £220,000. That means that that property has grown by 20k, but you've got 2 of those properties, so again, you've seen £40,000 worth of growth, which is a 40% return on investment. So that is a very basic understanding of why you would look to leverage and use mortgages to purchase your property rather than buy in cash or buy outright. What you'll often hear is, yes, okay, well, that works there, but I can get a way better yield on a cheaper property. I can get a 9% yield rather than a 6% yield. So let's look at those numbers and see what that means for us moving forward. So you buy a property worth £100,000, getting a 9% yield is an income of £9,000 a year. So you can see that here with no mortgage costs because you don't have a mortgage on the property, no service charge or estate charge, and we're assuming that we're not getting the property managed. So we're self-managing the property. That's £9,000 a year. That times 2, because it's the 2 years, is £18,000 plus the £10,000 worth of growth in that 2-year time frame is a total of £28,000 in that 2-year time frame, which isn't bad. It's not a bad return on investment. Having said that, you've obviously put 100 grand into that property. It's okay return, but we can do better. Also, one thing to be aware of with this is it doesn't include maintenance and management. And often when you buy a property at the lower end of the market, so a cheaper property in and around the 100k mark, they're older properties that need some maintenance, and that will then start eating into your yield moving forward. So it's something to be aware of. That 9% yield might not be 9% net, it might be 7% net. We can then look at the £400,000 property. So at the 400k property, assuming that we're getting a 6% yield, we'll be making around £7,800 a year. So that is assuming the mortgage rate. We're going to put that at 4.5% in the current market, but that obviously can change moving forward. But on that assumption, we're going to say we've got no service charge and no estate charge like the other one. And again, you're self-managing. So you've made £7,800 a year plus the £40,000 worth of growth in that 2-year period, which is a total of £55,600, which is obviously significantly better than if we bought a property outright for 100k cash. Having said that, it can be quite difficult to find properties that do yield at that 6% mark in areas that will continue to grow in value at the 400k mark. It's why we might look at properties that are slightly more affordable so we still get that growth and we can get that yield moving forward. So let's look at the 200k property. The £200,000 property, assuming that we're getting a 6% net yield again, will earn you £3,900 a year profit. That's after you've paid for things like your mortgage, and again, we're self-managing and we've got no estate or service charge on this property. So the £3,900 for the 2 years, we've then got the £20,000 worth of growth during that 2-year period, which is £27,800. So a decent return. Again, we've bought 2 properties here though. So rather than just the £27,800 return, we've actually got a £55,600 return, which is significantly better than if you just purchased one property outright for £100,000 in cash. The one thing you have to be aware of with this is that you have to pay for double purchasing costs for certain things. So for example, you need to pay for things like legal costs and mortgage broker costs twice. So let's look at the numbers. So if you purchased a property for £100,000 with a 9% yield, it would make you around £28,000 in that first 2 years of owning the property. The £400,000 property with a 6% yield would earn you around £55,600 in that 2-year time frame, and the same with the £200,000 properties because you've bought 2 rather than just the 1. Remember though, this is only 10% growth over a 2-year period. The more time we own the property and the more growth that we see while we own that property, it makes more and more sense to use leverage and use mortgages to purchase our investment properties. You can see that here. If you bought a property for £100,000 with 5% growth every year for the first 10 years, you would then have around £162,000 equity within the property. Remember, it's 5% compounding, so 5% on the new value after year 1, 5% on the new value after year 2, and so on and so forth moving forward. Instead of that, if you use your cash to buy a property for £400,000 with 5% growth a year, that property would then be worth £651,000. That's £351,000 worth of equity after 10 years. And again, the same would be right for the £200,000 properties because we've bought 2. So if we just look at one property would then be worth £325,000 in 10 years with an equity of 175k, and you obviously double that for the 2 properties. So as you've just seen, leverage is a brilliant tool to build and scale your portfolio and maximise your return on investment in property investment. However, there are some risks you need to be aware of. The first risk is interest rates. If interest rates change, obviously your profit will drop, and when you're buying property, you need to make sure that you're comfortable with changes of interest rates. We've seen this quite a bit over the last few years with changes of interest rates, essentially because people got comfortable with significantly low interest rates on their mortgage. They didn't look and stress test enough to see what would happen if interest rates changed. That meant that properties suddenly didn't cash flow and they had to go and sell those properties or make a loss. The other issue you need to be aware of is the possibility of negative equity. If you purchase a property worth £200,000 and the market suddenly crashes overnight, that property will drop in value and then you are in negative equity. Having said that, what you don't want to do at that point is panic. If you're still making a rental profit, the chances are the property market is likely to recover if we look historically. So hold that property, make that small profit in the short term, and in the long term, you should catch up with that negative equity and then go on to make significantly more cash moving forward. The final risk is over leveraging. Yes, leveraging is brilliant within property investment. If you over leverage and ultimately take on too much risk, then you could be letting yourself open for lots of problems down the road. And like anything, know your numbers and give yourselves a cushion. So when should you leverage? Most people leverage early on in their investment journey because it maximizes their return on investment and gives them the opportunity to build their wealth and scale their long-term portfolio. You'll see people refinancing every few years, taking equity out, releasing that equity to purchase more property, and so on and so forth. You'll often see it within the buy, refurb, refinance strategy, but you need to be aware that you're not over leveraging when you're trying to release equity from this strategy as well. As you go further down the line with your property investment journey, and you might have a significant portfolio at that point, you might decide to leverage less and less over time to give yourself a slightly better rental income. So to conclude, leverage can really give you the opportunity to build and scale a long-term profitable property portfolio, but you need to respect it and know the risk when you're getting involved. We haven't even touched on the benefits of inflation in this video when you're looking at leverage, but we'll cover that in another video. So let me know in the comments if you have any more questions on this topic or if there's any other topics you'd like me to cover, and let's go from there. Cheers.